Okay, we're at 7:03. Maybe let's begin. Hi, everyone. Thank you so much for joining us this evening for our event, Singapore at 60, Charting the Next Decade of Investment. My name is Justin Jimenez. I'm the head of macro and investment research at StashAway. And today I'm delighted to be joined by our two guests. First, we have Kenneth Tang, Senior Portfolio Manager at Nikko Asset Management, and Kang Wei Chin, Director of Securities Trading at SGX. Before we begin, just 2 points of housekeeping. First, just like a reminder that the information presented today is for educational purposes only and shouldn't be taken as financial advice. Please consult your financial advisor or hopefully your StashAway wealth advisor for guidance that's tailored for you. Second, we'll have some time for Q&A at the end. So I encourage you to type your questions for those of you on Zoom into the Q&A box, and for those of you joining us live on YouTube in the comments section. In terms of what we'll be covering tonight, first I'll briefly introduce StashAway and our approach to investing in Singapore. Then we'll jump into a virtual fireside chat with Kenneth and Wei Chin to discuss Singapore's equity and ETF landscape. And finally, as I mentioned, we'll wrap up with some time for your questions. So for those of you who might not be familiar with us, StashAway is Asia's leading digital wealth manager. Our mission is simple: to help people build and protect wealth for the long term. We've been around since 2017, and today we're licensed across the 5 jurisdictions where we operate, those being Singapore, Malaysia, Hong Kong, Thailand, and the UAE. We're also backed by some of the world's leading venture capital firms, and your funds are always held securely with the global custodian banks listed on this slide. On our platform, we've built a range of solutions to meet different investing needs. We have cash management solutions for short-term goals, core portfolios for long-term wealth building, thematic portfolios if you want to capture big megatrends, and finally, we also have access to private markets and alternatives for accredited investors in Singapore. And one of those solutions is related to our focus for tonight, that being investing in Singapore. So if you are looking to invest in Singapore, we do offer a Singapore investing portfolio that's built around a mix of equities, REITs, and bonds via 6 SGX listed ETFs. It's designed for long-term wealth building and also has a bit of an income component to it as well, and structured at about a conservative to moderate risk profile. It's simple, it's flexible, no lockup, no minimums, and you can choose to reinvest or receive dividends. And when I think about Singapore as a market, a few things kind of stand out to me. For one, the STI, the Straits Times Index, has had a really strong run this year, more than this year, of about 31% over the last 12 months, which is almost double what we've seen in other major global markets. And importantly, I think it's also one of the highest yielding dividend yielding equity markets out there. On the bond side, we've seen steady flows into Singapore government bonds, maybe perhaps related to some safe haven appeal, as well as some IG investment grade corporates in Singapore, which give investors a little bit of an extra yield pickup over the sovereigns. So when you put all those things together, income, diversification, and stability, the case for investing in Singapore, especially as part of a diversified global portfolio, can sound quite compelling. But instead of just hearing it from me, let's bring in our experts for their take. So I'd like to welcome Wei Chin from SGX and Kenneth from Nikko Asset Management again. Thank you both again for taking the time to join us tonight. Maybe to get us started, let's start with maybe an icebreaker question. That being, if you had to maybe describe Singapore's ETF market in one word or phrase today, what would it be and why? Maybe, how about Wei Chin? I saw you unmuted first, so let's have you start.
Sure. I think for me, I would use the phrase flight to quality yield. And that is really because in recent months, we have seen investors increasing their allocation using ETFs that contains SGD assets. So today we have close to 50 ETFs with a combined AUM, asset under management of 15 billion. And that really shows the interest of investors using ETF for their portfolio, because 5 years ago, when we just started Singapore investing, then it was called income portfolio with StashAway. Total AUM was about 5 billion. So we have tripled in market sizing. And throughout this journey, we have also seen our Sing dollar asset class, Singapore ETFs, including equities, bond, and REITs, grow to a scale of over 6 billion in asset size. And most of the flows that are coming in over the last few months has gone predominantly into the STI as well as the S-REIT and also Sing dollar bond assets. And you can see one of the commonalities across these three themes is that they all give pretty decent yield to investors.
Great, thanks, Wei Chin, for that. Turning to you, Kenneth, how about yourself? Yeah, if you had to describe it in one word.
Sure, Justin. I think Wei Chin used 4 words. I'll use one. I would say ever-changing, and if another word I would use would be obviously evolving. As rightly Wei Chin put, I mean, the ETF market has been an area of growth for Singapore. And I think if you look at the AUM of the total ETFs today, it's about 14 billion. I sit in, obviously, being a manager of one of the STI ETFs, out of the 14 billion, 3 billion is actually accountable by 2 large Singapore ETFs for the STI. And you can see that that's actually a chunky 20% of that ETF market. So clearly, this is a number that is actually a much bigger number than it was before. So clearly, this is a market that's evolving. The ETF market has gone from strength to strength. And I believe that will continue to be the trend going forward, where we'll start to see a greater ever-changing landscape for Singapore, where ETFs becomes an increasing part of investor allocation.
Great, thanks for that, Kenneth. I think that's ever-changing. If you put a hyphen in that, that's one word. So I think you're...
Indeed, it is.
Good for the eager for the prompt. So, but yeah, let's maybe zoom out to the big picture, I guess. Why is investing in Singapore focus? So, as Wei Chin mentioned, as well as you, Kenneth, this year's been quite impressive for the SGX. The 47 ETFs listed on the exchange saw in the first half of this year at least net inflows of about 700 million Sing, pushing AUM past 15 billion. Trading volumes are up 44% year on year, and all of that for me put together really suggests a renewed appetite for Singapore assets. Maybe I'll turn to Wei Chin first. From your vantage point at the exchange, what do you see as driving the surge in investor interest? Is it temporary flows, or is it maybe a deeper shift in how investors view Singapore as an allocation in their portfolios?
Sure, thanks, Justin. And I would just like to elaborate further from where Kenneth left us with on STI. Certainly, we came a long way. In fact, the first STI ETF was listed over 20 years ago. It took about 17 years for the 2 STI ETF to cross 1 billion. That was 2019. And only in the next 17 months, we crossed the 2nd billion. And this year, we hit the $3 billion milestone. And that really shows how far ETF, or rather Singapore equities ETF, has formed a core building blocks of many local investors. But we have since then diversified beyond this. So investors' interest no longer limit to only STI. Certainly STI is one of our major drivers. But today investors are going into a more granular and more nimble way of allocating their investments through ETFs. For instance, across the 6.4 billion of Sing dollar assets, 3 billion from STI, and we do have a couple other Singapore equities ETF, but the next biggest block is really the S-REIT and Asia ex-Japan REIT ETFs that list on SGX. And in total, our REIT ETFs, which is very much Singapore REIT focus, has crossed 1.3 billion. And that is really a testament where investors have more options today in the way they want to build their building blocks. If they want to overweight on REITs, they are increasingly using REIT ETFs to form their core building blocks. And also, besides REIT, we do have a wide range of fixed income ETF, very heavily skewed towards the Sing dollar assets as well, which in recent months, it has proven to be a safe haven because with the rapid, I would say, earlier part of the year, there was a rapid drop of foreign currencies like the USD. We have seen investors pivoted into S3D bond assets, right? So at this point, it's not really a temporary flow, but we do see a pretty much realization, I would say, of investors that ETFs can be a way for them to find pocket of opportunities as well as for core portfolio allocation when they are building their be it retirement or passive income portfolio.
Great. Thanks for that, Wei Chin. Maybe I sort of turning to Kenneth, digging deeper into maybe that first bucket. We'll go into those other asset classes as we sort of go through this fireside chat. But I guess, how do you see this renewed investor appetite squaring with the fundamentals that you're seeing in Singapore equities in particular? What is your case, I guess, for the Singapore market right now?
Right. It's a good question because clearly it's an important question for investors because the market has run up a fair amount of, in the last 2 years, I think, back to back, I think STI has given investors a cumulative performance of about, 35 to 40%. It's a very attractive return. It's great if you have participated in it, but the bigger question is whether it continues. And I think our conviction is really predicated on the fact of why this has taken place. And what we find today in Singapore is really backed by fundamentals that earnings and dividends are growing. And one of the reasons why we think this has actually blended into a higher return is because we have seen a lot more corporate earnings in Singapore start to improve. Post the COVID period of 2020, we have seen earnings actually come back with a vengeance. And a lot of the corporates in Singapore are also translating these earnings into dividends, meaning they are paying out more dividends than they have ever done before. And I think that's actually been really driving the markets higher because you need fundamentals of earnings to really catch up with where the market is right now. But I think another reason where I would like to add to what Wei Chin shared earlier, why Singapore, and I think it's really important, is because I'm not entirely familiar with the attendance from investors, whether it's local or foreign, but Singapore is a very attractive sovereign asset today. I'm sure many of us have thought back in the last few months, what does Liberation Day, what does the time of deglobalization mean for investing? And I think Singapore has been, fortunately, a very good allocation for the investor who wants defensive growth, who wants safety, and who also wants stability. And I think Singapore has actually offered investors that comfort. And I believe that will continue. Singapore is very blessed because while we are hit with tariffs and we're going to get 10% to pay to Trump, but still 10% is quite good compared to a lot of our peers. So we see that Singapore is really a relative winner in the whole scheme of deglobalization. And I think the equity market is a reflection of those fundamentals.
Great. Thanks for that, Kenneth. Maybe a follow-up question. So those were the, I guess, pros, the opportunities in Singapore. Maybe on the flip side, it's always good to have a bit of to sort of understand the risks. I guess, what risks do you think investors should keep in mind if they do increase exposure to Singapore or get into the market at this point? You said the market's run up quite a bit. Are valuations a concern, for example? So.
Sure. Again, it's a very apt question. I think the first risk is really, obviously with rising markets, you can also call a bit of euphoria in equity markets in the past 12 to 18 months. The greater risk is obviously of a drawdown, and the reasons behind that drawdown will likely come in our opinion, because of more macro concerns to do with interest rates, to do with a sharp, exogenous risk that we see globally that would actually derail this rally. So I think the risks clearly are elevated at a much higher level. But when we look back, Singapore has typically traded in a range of, the low teens of 11, 12 times forward valuation to a high of 15 to 16 times. So today we're sticking closer to the upper end of that range. So I wouldn't say that Singapore is expensive. I would say that there's still a good fundamental case, but the clear risk factors is really about global, what exogenous risk that we face on a macro level. And domestically, if earnings disappoint and dividends disappoint, which again goes back to my first point about the rising earnings growth story, I think that would be also one of the key risk factors that we are watching. So I think it's important to stay clued into really where opportunities are in growth, as well as in the sustainability of this rally in terms of thinking of what the risk factors that could be of concern.
Great. Thanks, Kenneth. So that was the broad equity backdrop. One of the another big driver in markets this year that you mentioned have been rates. So maybe let's turn there. So bond yields in Singapore, they've come down pretty meaningfully this year. So the 10 years at about 1.8% from about 3% at the start of the year. How does the current rate environment affect how you think about Singaporean assets more broadly, whether those be equities, REITs, or bonds themselves?
All right, I'll have a go first as well. I think a modestly accommodative backdrop for interest rates is going to be key for the sustenance of the rally, both in equities and fixed income. I think what could perhaps be more constructive for markets, meaning what could be positive for markets, it will be rates to continue to go lower. I think just a couple of days ago, I think we have all heard the news that the Powell will start to reduce rates as soon as September. And I think that's really the backdrop of what we want to see for risk assets such as Singapore equities and even corporate bonds. So I think that has actually been a very nice tailwind for performance. But if one had to drill down to the next level of what looks more attractive relative to each other, I would say that, I'm probably a bit biased because I'm an equity person. So I would say that at this point, I would think that equities would still rank a bit stronger than bonds, just on an absolute basis. And the reason is really more predicated by the sharp fall that we have really seen through bond yields. I mean, a year ago, everybody was buying T-bills with a nice 3% or 4% handle. And today we're living with 1.5, right? And I think this has actually halved in the past 12 to 18 months. But if you think about dividend yield for the Singapore market, which ties into equity yields, the dividend yield of Singapore today is still giving you high 4s to 5%. That's the same number that you got almost a year ago. So actually you start to see then the relative comparison between equity yields or dividend yields versus bond yields to really shift now more towards equities. And this is really why we continue to remain more constructive. Singapore is a high dividend paying market. And the good news is that dividends yields are here to stay. So I think that's going to be very attractive. So I will kind of rank equity versus bonds. For REITs, I think this is a very interesting question because REITs have been a very big part of the Singapore DNA or equity market. And I would say REITs, again, look to me a lot more attractive, again, versus bonds. And that's the reason also because if you think about the carry or the premium of REITs today, we're still talking about a 300 basis points premium towards fixed income. And I think that has traditionally been always seen to be a good entry point for REITs itself. And we will probably continue to see that, assuming interest rates were to continue to fall. So where is the risk? All that I've just said, I'll put a caveat to it. What could change that ranking order if rates will start to reverse and we start to see another spike in interest rates? That could clearly be a lot more challenging for the narratives of ranking between these asset classes.
No, thanks, Kenneth, for that multi-asset perspective. Perhaps, unless Wei Chin, unless you have any sort of thoughts on the bond market, we can maybe dig deeper into REITs. So, yeah,
I just wanted
We
to
can go to
sorry, Wei Chin,
go
go
ahead,
ahead.
Kenneth. No worries. Go ahead. Yeah.
No. I also think that within in fixed income or bonds, there's clearly also different tiers. There's clearly the government bond and the bond index or the bond of ETF that you can invest in, and also the corporate bond ETF for investment grade as well. So I think there's also that tiering where there's also a little bit more preference that we feel, again, based on the yield differential that the corporate bond ETF offers ahead of the government bond. So again, it's again about the risk parity of different asset classes. And by that, we also are quite constructive that the corporate bond outlook for ETFs will be also remaining quite attractive. So that's my point.
Yeah, so I just wanted to add on to that point on what Kenneth just touched on corporate bond. In fact, across our fixed income ETF, the corporate bond ETF, SGD corporate bond by Nikko AM, has been one of the ETF that has garnered most flows over the last 3 months. In fact, it has recently crossed 900 million, pretty close to $1 billion threshold. And the interest is really on the back of institutions. And we are seeing retail investors looking to lock in their yield for a longer duration. So if I'm not wrong, the Nikko corporate bond is a duration of just above 5 years. And that is getting more attractive to investors who are worried that rates will continue to trend lower, given that as Kenneth mentioned earlier on, Powell sent a message that rate cut is going to happen in US. Singapore may be affected from that as well. So investors are really looking into corporate bond ETFs as a tool for them to further lock in their rates for a longer period. And as we all know, duration, the longer is, the more sensitive it is to rates cuts. So if a duration of 5 year, most likely if rates continue to trend lower, they might enjoy price gain on top of the regular dividend coupon payments. And last but not least, I think one of the reasons why we are seeing a lot more retail investors participating in a corporate bond ETF is also because it's not easy for retail investors to source for corporate bonds. Typically, they will only come in certain part of the market of the year. If they do come out, the sizing is pretty big. You're talking about a couple of 100,000 per issuance, or rather per subscriptions. Not all bonds are open to retail investors. A lot are only to accredited corporates. So I think that's where we are seeing a lot of investors starting to appreciate the beauty of subscribing for a corporate, or rather for investing or buying to corporate bond ETF, because very different from govies, right? Government bonds. I think today most investors are very familiar with how to buy T-bills and T-bonds. But corporate bond remains one of the harder to access, one of the less liquid market where ETF has a role to play.
Yeah. And I will also add to Wei Chin's point, again, coming more from an equity perspective, a lot of the corporate bond issuers are also listed on the stock market. And many of them have actually been able to capitalize on the fall in interest rates. And as a result, have actually been able to get a better rating as a result of that lower rate environment. So that again becomes another pivot towards the ability for that yield to be realized and also to be enhanced. So I think that's a really very apt point that was mentioned by Wei Chin, that the real corporate bond ETF does offer investors at a time like this.
Great. No, thanks both for that color on the bond market in Singapore. I guess, yeah, maybe from here, let's, as I mentioned, jump to, I guess, the next asset class that's also on investors' radar, as Wei Chin mentioned earlier, after the STI. interest in REITs is, has been, increased a lot lately. They're yielding, S-REITs in particular, are still yielding upwards of 5%. And after a difficult stretch over the past few years, the property market does seem to be stabilizing quite broadly. And as you mentioned, rates are trending lower. So, taking a big picture view, do you see this as a start of a more favorable cycle for REITs that includes not just those dividend yields, but potential for capital appreciation as well?
Right. I think the answer is yes. I believe when you look across asset classes, and I've done so for many years, there isn't one sector that's probably the most sensitive to interest rates as property. And even though property REITs is a little different because it's a more stable structure of REITs and unit and business trust, the same rule applies. That when you start to see a fall of interest rates, asset-based businesses that are dependent on obviously gearing and the leveraging up of capital to grow earnings or grow DPU in the case of REITs will benefit. So I think there is a good case for REITs today. And with the rates likely to go lower, I believe that will be also supporting the broad outlook for REITs. And I think if one had to look back in the last 3 years, I feel that the reason why REITs struggled was really because of number one, the impact of higher rates, and also the trajectory of what we consider to be very critical, which is called DPU growth. So it's almost like the direction of rentals in the retail assets, in the office assets, in industrial assets. And the thing that we find today in most of the REITs is that many of these asset classes are starting to see a bottoming out of their rentals. And that will actually be supporting for DPU to start to inflect positively, which will be obviously good for REITs. But it's not an across-the-board story. I would say that it all depends on really the different asset classes across different REITs that kind of conjure the opportunity set for growth to move higher for those asset classes.
Maybe to that point, actually, a follow-up question. In terms of the different REIT segments, are there any that you see as better positioned to lead? Industrials, retail, data center, tied ones?
Right. I think it's a very interesting question because if you look at the demography of REITs today, there's actually many REITs in the office, the industrial, and probably the retail space. And these are many familiar names that we know, the different Maple Tree, as well as Capital Land, REITs that we all know and invest in. I think what I believe would really drive performance for REITs is really more the asset classes that underlie these assets. And I believe most of these that I mentioned will generally be okay. They'll be probably stable to moderately rising. I think the sectors that we particularly like more in this time is really sectors that can give you growth. Again, I will wear a growth hat again, and then everything that I look at, because I'm an equity person, I always try to find where growth is. And where we find growth most in REIT land or in the space of REITs is in data centers, as well as in hospital or healthcare REITs. And I think these are the two asset classes that I believe will give more growth in a time where perhaps yields are trending lower. So you can think of it more like you get probably a capital upside appreciation from that growth in DPU on top of the yield that you get, which is already quite attractive.
Great. Thanks for that, Kenneth. Maybe Wei Chin, taking the sort of SGX perspective, you mentioned earlier sort of why bond investors might look to ETFs to gain access to certain segments of the bond market. I guess from your opinion, why should investors choose to access S-REITs through an ETF instead of buying individual REITs or property directly? And I guess comparatively, how does Singapore compare with other regional REIT markets? There's a lot to unpack there, so maybe we can break it up into two questions.
Yeah, sure. Maybe I'll reverse it and start from the second question, and how do we compare with others in this region?
Sure.
Singapore is In fact, we are the largest REIT market in Asia ex-Japan region. In APAC, there are a few big blocks of REIT listing venue. You have Australia REIT, Japan REIT, and within Asia ex-Japan, Singapore, in fact, make up over, if I'm using Nikko AM AXJ REIT ETF as a gauge, we have about 70% of the market share. Right, so I think that's a very one key reason why I think Kenneth used the word blessed earlier on. For Singaporeans, we are quite blessed in the sense where if it comes to REIT investings, we do command a pretty stable yield in most of the quality as REIT listed on S3X. In terms of stability, why we are talking about stability is because despite over the last few years, investors may see that the price levels of some of the REIT ETF is flat. However, they have constantly paid out dividend yield, and most of them have been constantly paying out a dividend yield of above 5%. So that's one testament of this real estate investment trust ability to continue generate yield despite tough times, right? And I think that's one of the key reasons why investors in Singapore do have a keen interest in using REIT as one of their core building blocks. So next question is on why investors choose to assess REITs by ETF. Many reasons. I think the first one I've explained. If you look at regional REIT exposure, for instance, FTSE EPRA NAREIT index, AXJ index, that covers REITs beyond Singapore markets. So if you are buying an ETF that tracks the index, you are effectively assessing 70% Singapore REIT, probably about 10% or more Hong Kong, plus some of the regional REIT exposure. It's not easy for individuals to open up multiple custodian account across multiple exchanges. It is quite complex, especially if they're assessing some of the emerging market REITs like India or Thailand. So these are some reasons why REIT offer geographical exposure. The others is even if you're looking at single country like a pure S-REIT ETFs, ETF offer ability to do a single trade execution. If you are looking to buy into 20 REITs, right, it could be quite costly to execute 20 times. The hassle of managing 20 REIT in your portfolio, how do you rebalance? How often do you rebalance? How do you filter good from bad REITs, right? How do you filter, in fact, a more quality REIT in your portfolio? Most index would have index rules that helps you to filter some of the more quality REITs, be it based on financial ratios, be it based on its trading liquidity, auto filter off the more illiquid REITs that you may not want to manage in your portfolio, right? These are a lot of works to be done. And on a personal capacity level, it could be quite tedious and almost impossible to manage. Another fact is that REITs itself probably will have more corporate actions, including right issuance, on average compared to companies. And for someone who is investing using SRS, as we know, there is a limit of $15,300 contribution. So if you're using it for REIT exposure, REIT ETF is perfect because it would then avoid the need for you to put out cash for right issuance, to subscribe for additional rights, because all these actions, corporate actions, would then be managed directly by the fund manager. So that's again another convenience that the ETF brings to investors. Last but not least, based on the current spreads in terms of the spreads is a form of execution cost for investors. The average bid-ask spreads that we see for our top traded REIT ETFs typically is a fraction of what the underlying REIT has. For instance, the average basket weighted REITs bid-ask spreads could be about 60 basis points, which is 0.6%. But for ETF, it could be way below 0.3%. So that's more than 50% savings for those who are sensitive towards the spread you're paying when you're buying and selling a particular security.
Great. Thanks, Wei Chin, for that super detail on sort of the pros and cons of REITs and accessing it through ETFs. So we've looked, we've spent the past 37 minutes kind of looking at where we are today. Maybe let's finish off by looking forward. So maybe let's start with Kenneth. Looking ahead, what catalysts, whether they be big macro catalysts or sector-specific ones, which do you see sustaining investor interest in Singapore equities into the end of 2025 and beyond?
Right. Well, great question, and it's probably a good question to end off the discussion or to continue the discussion. How can we not cover the biggest story for Singapore equities today, then not to talk about the equity development program that the government is obviously helping to value up Singapore. And I think it's important to also know that this is an interesting time for equities, because that's kind of front and center of the government's focus on growing and crowding in capital for the market. So I think this is a very strong message that all the things that we talked about, the ability to have investability in the stock market through ETFs or through other instruments, is a focal point for the government. And I think with the expectation that this program will help crowd in more investor interest into Singapore, I think it will really help better price discover what the ETFs can offer in Singapore itself. So I think that's a really exciting time for equity managers, including ourselves. And I believe this is actually something that we think is going to be a very exciting period where we're going to see a lot more fund flow coming into the market. And we believe ETFs will also be a beneficiary of that. I think the second thing that I would also say is that I think while we shared about the great evolution of how ETFs have grown, the $15 billion number, let me just share a stat with you. The free float market cap for Singapore today is basically $500 billion. And if we think about 500 billion, that 15 billion of ETF is just passing 3% of the market. So when we look at that, we have definitely grown by leaps and bounds, especially over the last few years. But as a capital market itself, we are far lower than any other developed market where we have the ETF and the funds business for asset management owning a big part of our stock market. So I think that's going to be very exciting, because I think this growth will continue. We're going to go from 3%, hopefully, to 5%, to 10%. And I think this is going to be great times for investors that will have participation in both the equity and corporate bond market as well.
Great. Thanks for that, Kenneth. Sounds, exciting times ahead. Wei Chin, maybe turning to you from your side at SGX, are there any maybe sort of looking ahead, are there any other trends, whether they be product trends or big macro trends like the equity market development program that investors should be watching for in Singapore's ETF market?
Sure. Probably just to continue from where Kenneth left us with in terms of the growth of market, I think just to share a bit on adoption trend as well. One of the trends that I thought is useful to share here is in terms of the usage of ETFs. We are seeing beyond direct investing, investors are warming up to the idea of using regular savings plan and robo-advisors, for example, Singapore investing via StashAway, to gain access to ETFs. As of last year, we have crossed the 1 billion milestone. So today is approximately close to 1.2 billion of assets driven by regular savings plan as well as robo-advisory. For retirement planning purposes as well, we are seeing a sharp growth in adoption across SRS and CPFIS investing using ETFs. Why? Because there is no cheaper or even lower cost of investing by owning the ETF for your retirement portfolio. And because retirement is for long term, we do see ETF as a core building blocks to save costs over time. And I believe through Singapore investing, investors can also use SRS to fund their ETF portfolio allocations. So there's a lot on adoption trend, and I think these two will continue to, they today form a 40% market share of retail adoption. I think these are the key ways that investors will continue to use ETF via a more systematic way of investing, regular savings, as well as using it for their long-term investment planning. In terms of innovation product trends, local underlying, Singapore underlying, be it bond or fixed income, is certainly a space that we continue to work with issuers to deepen the products offering. We are looking to launch and work with issuers to go beyond passive and to also increase our active ETF listing on SGX so that investors will have the choice between tracking a passive index or leverage on the manager expertise to invest into active fund. And beyond Singapore, we do acknowledge that investors will need more building blocks to access global markets. For instance, with Nikko AM, which soon will be renamed as Amova Asset Management, we have launched the world first Asia ex-Japan ex-China ETFs. So this is really for investors who wants to manage China allocation separately and tap into the growth of the other Asia emerging markets. That's first in the world, and we have seen a growing adoption in that front. Similarly, with Amova, or rather with Nikko AM, we have also launched the first Singapore hedge version of Chinex ETF. For those who are less familiar with Chinex, it's the Nasdaq of the East, as it market itself has to be. These are core building blocks for individual assets portfolio, asset management portfolio. So for those investors who have other ideas, feel free to leave it in the comment box, as SGX is always happy to source for new ideas from investors.
Great. Thanks, Wei Chin, for that. So I guess that kind of brings us to the end of our fireside chat. Before we go into Q&A, maybe let me give you a chance for each of you to give one final takeaway for our audience. So if you had maybe one takeaway about Singapore's market today, whether it be the equity market, the ETF market, what would it be?
Maybe I can go first. I think I've managed Singapore for a good part of my past 30 years in Singapore. And I would kind of describe today's environment for Singapore to be really attractive from the perspective that, number one, we have an initiative to revitalize the local market. Number two, there's a greater proliferation of ETFs and new market instruments to make investing easier in Singapore. And thirdly, you have an interest rate environment which have constructively been historically quite conducive for investments. So you put that three together, these are actually very exciting times for Singapore. And in the last 30 years, we have seen different cycles. This is by far a very interesting cycle for investors to really consider in the context of the history of the Singapore stock market. So I think that's really something that I would take away from.
From my end, probably just two key messages. The first one is beyond STI. As you mentioned earlier on EQDP, the program that MAS has recently launched to encourage active fund managers to launch more funds that invest into the mid-small caps companies in Singapore. Over the recent few months, we have seen increasingly more net institutional inflows into our mid-cap stocks. And these are companies that are typically not found in the Straits Times Index. So the opportunities are growing in terms of pocket of companies where investors may be able to find growth and tap into the Singapore growing story. And beyond FDI is first, and next, beyond equities. Investors, if you look at our Singapore ETF market, equities is make up the largest portion, over 50%. But you can see that increasingly REITs, fixed income, even gold is being invested by local investors. And so investors no longer have to restrain themselves to equities investment when it comes to ETF. ETF can be used as an efficient investment tool for anyone who wants to gain exposure into fixed income products, like those that we have shared earlier on in this webinar, direct investment into REIT and also gold as an efficient portfolio building tool.
Great. Yeah, thanks both for those, I guess, not so final words, because we do have Q&A from the audience. So with the remaining time, let's, I guess, jump into it. I guess let's start in order of sending in these questions. So we do have a question about a specific company. So I think this may fall under Kenneth's purview. The question is, does ST Engineering have a long-term story? I guess, are there any sort of, does this company excite you?
Right. Okay. So let me just first place the, a kind of, we don't offer investment recommendations, at least not in this panel, and whatever we say would be really more expression of our view. So please, caveat emptor, invest accordingly. But what we can say is that ST Engineering is it's really a very strong what we call Singapore moat. Singapore moat is defined as really a company that has one of the best returns on capital in terms of its ROE. And ST Engineering has actually established a very sustainable moat of continuing to deliver this high ROE in a time like this. The stock has done very well and clearly has really resonated with investors that this is actually a very strong growth moat to invest in. So to answer whether it's a good long-term story, I would say that yes, it does. Because if you look at the very important pivots that drive ST Engineering, you have number one, what's happening in global defense. And it's clearly a big investment today in the theme of defense in general. And there's actually a very small group of stocks globally that you can actually invest in that theme. And on top of that, ST Engineering, by the name of the virtue of their name, is an engineering company. So there's a lot of IP in engineering in the way they manage transportation networks. They do a lot of technology investments. I mean, they help to power up a lot of our ERP networks. If many of us may know that we get taxed every day from driving. I mean, this is just a testament of ST Engineering's capability in their technology and their IP in engineering. So I think that's really a very interesting company because it's really telling you that growth prospect that could be actually sustainable.
Great. Thanks, Kenneth, for that, and thanks for the caveat and Tor as well. Good reminder for everyone as you sort of go through these questions as well. We do have another question, this one coming from Edwin Tay on YouTube. So AI has been driving US markets. Are there any similar stocks or perhaps even ETFs in Singapore that are driven by, that capture this same AI theme? I guess either of you could jump in.
Maybe I can start off with the ETFs that are related to AI companies. In fact, while we don't have an ETF that is named after AI, if you look across the tech-focused ETFs on our market, many of them do have companies. In fact, they are allocating a lot of their spending into AI research. Good example would be one of the ETF listed probably by almost four years, Hang Seng Tech ETF that's listed locally. It tracks the top 30 tech companies of Chinese tech companies. And you can see a lot of these Chinese tech has been spending heavily in AI research capabilities. So that's one that you can capture China tech story. And if you want a more granular exposure into some of the very niche sector, for example, EV sectors, that's one of the ETF that is listed on SGX that tracks the MSCI, China Electric Vehicle and Future Mobility Index. In fact, that is ETF issued by Nikko Asset Management. And last but not least, one of the more recent innovative product that has been launched on SGX is the Southeast Asia Plus Tech Index ETF. And that really helps to fill up the missing gaps where investors who are looking to invest into US, China, and now they have a third building blocks that allow them to tap into the Southeast Asia and India tech story. So these are some of the examples. Of course, in addition to the Chinex ETF I've shared earlier on, these are some of the examples of ETFs that have exposure into companies that are fast growing, that are investing pretty heavily into AI capabilities.
I think that are great points from Wei Chin. I would just add that at the stock level, it's quite rare that not just in Singapore, but in Asia, do we find any direct AI plays or AI stories. what we commonly find more is actually a greater ecosystem of where AI plays into. So for example, in the area of power, because AI clearly needs a lot of power or electrification, there is clearly a lot of utility companies or suppliers of energy that would actually play into that theme of AI growth. So when we think about AI in Singapore, we often look at really the industries that could benefit directly and indirectly from these trends. And clearly utilities, which is actually one of the sectors that we like, is playing into that narrative. The second story clearly is linked and is usually technology, because a lot of the chips, the ASIC chips, as well as the chips that require a lot more of that enableization of the AI theme, is also companies that are in the manufacturing of the chips, as well as in the equipment required to supply to the AI story as well. So technology as a sector itself do have that kind of benefit from an AI story theme. So I think these would be how we can look at, you know, other stocks in Singapore that could actually benefit from this AI story.
Great. No, yeah, AI is the theme du jour, so it's great to hear that there are sort of opportunities in the Singapore market as well. Maybe turning to a different topic, currency. So Alagapan on Zoom saying, you know, the Sing dollar has strengthened quite significantly this year. On the flip side, the dollar has depreciated quite significantly this year. How do you see these currency fluctuations impacting, I guess, Singaporean equities in terms of their overseas exposures? Is that something we should, you know, worry about or take into consideration?
I think Mr. Alagapan has a great point in the sense that in the last few years, we have never seen a year where the Sing dollar has appreciated against the US dollar by such a magnitude as a year like this. I think when you work back, you know, your Sing dollar, US dollar return is somewhere in the mid to high digit level, single digit level. So if you are a US investor investing in Singapore, you get another 6% carry on top of your STI return. So that's very, very strong. Unfortunately, it works the other way around too. So if you are a US investor, or you are a Sing investor investing in the US, it's clearly a very material impact on your returns as well, which is why when we look back in Singapore over the last 3 years, many investors will be surprised that on a Sing dollar basis, the Singapore STI has actually given very similar, in fact, even better returns than an S&P, which is kind of quite hard to kind of put down together, right? So I think that's really a function of currency, and because of that currency move, I think that will be increasingly quite material in the view going forward, because we do feel that Singapore continues to be a very well managed economy that will really underlie the fundamentals of the Sing dollar. So we do feel that the Sing dollar over time will remain relatively strong compared to its the rest of the world. So I think that's going to be an important consideration. So put more money investments here than overseas, basically what I think is really relevant here.
Great. Thanks for that insight, Kenneth. Yeah, currency has definitely been something we've been watching as well. Maybe to end, we do have a few sort of product-specific questions that maybe Wei Chin can take. I'll just kind of group them together for the interest of time. There's some interest in covered call ETFs, as well as you know, crypto-themed ETFs. Are there any? Can you discuss any sort of like plans or you know, hints at sort of the availability of these sorts of ETFs in the Singapore market in the months, maybe quarters ahead?
Yeah, certainly we do not yet have covered call or crypto products on SGX, listed on SGX at this point. But this is a space that we're watching, and certainly good to know that there is interest. And I think the question is also about tax that is being faced from US-based ETFs. I think that's a valid concern. That's an extremely valid concern when it comes to investing into ETFs, and which is why REIT ETF has gotten the popularity that we have seen in recent years. That's largely because investors who buy into REIT ETFs, they do get the full dividend payout due to an exemption that was granted by IRAS early on years back that allow investors to receive full dividend payment from the underlying REITs. But that aside, at this point, we do not have a covered call ETF, and not possible to give a timeline, but certainly these product innovations are something on top of our mind, and we are working with asset managers, including Nikko Asset Management, on potentially broadening into this space.
Maybe one more question. I think we have time. How do you see retail investors playing a role in shaping Singapore's capital markets over the next few years? Wei Chin, you mentioned earlier that retail investors have been playing more and more of a role. Do you have any would you be able to share any insights into that?
Certainly. And I think I shared a little bit on the adoption in terms of how investors are investing these days. I think retail investors in Singapore are a lot more hands-on in terms of given the tools that are available to them. For example, ETFs, right? They are using ETF that invest into Singapore capital markets as part of their systematic way of investing, regular savings plan. So these are going to create natural sticky inflows into our capital markets over the long term. And as the adoption level increases, this does compound, right? And a lot of these capital are eventually going to flow into our local stock market. Same goes for the use of CPFIS. Same goes for the use of SRS to achieve a longer returns over time. Like what Kenneth has shared earlier on. STI, despite being a lot less volatile than many of the global market indices, it has done well in terms of delivering return over a long period of time. And that is certainly over a long period of time, expected returns would outperform the low or even close to zero interest rates that SRS is offering. So I believe that is retirement planning as well as behavioral change in terms of regular savings strategies, right? These are going to bring in strong and sticky flows into our capital markets over time. I just want to touch on one question I see on the chat is about mid-sized companies. They are not part of STI. Will they be part of the new portfolio? I'm not too sure about the question on portfolio, but we do have ETFs, in fact, listed on SGX that captures companies such as Hopper. Beyond 2 STI ETF, we have another 3 Singapore-focused ETF. So I do encourage investors to explore some of the other Singapore-focused ETFs that do cover some of the mid-small caps companies. Yeah.
Thanks for that, Wei Chin. We do have, I will take one last question from Dmitry Kushnirenko. Does StashAway offer exposure to Singapore equities as a pure play? We do currently have a Singapore investing portfolio where Singapore equities are a part of the allocation. However, I can say that we are rolling out a product in the coming months where you can have direct exposure to Singapore equities. So keep an eye out for that. That's coming soon. With that, before we wrap up tonight's session, I'd just like to give a big thank you to Kenneth and to Wei Chin again for your time, for sharing your insights, and of course to all of you for joining us tonight. So we have 2 QR codes on the screen here. If you'd like to continue exploring Singapore investing with us, you can scan the QR codes on the screen. On the left, you can scan for a voucher to enjoy a free fee waiver for up to 50,000 Sing dollars managed for 6 months. And on the right, you can scan to connect with our client engagement team to learn more about Singapore investing or any of our other portfolios as well, or if you have any other questions related to tonight's event. So we'd love to stay engaged with you. So whether it's through our events, our insights, our portfolios. So thanks again, and we look forward to seeing you at our next session and staying in touch. Thanks, everyone. Have a good night.
Thank you,
Thank
everyone.
you, Justin. Thank you, Kenneth, and everyone.